Friends, I welcome all of you to today's session. And in this session, we are going to continue our discussion on capital structure theories. Let me share my screen. So, friends, in the previous class, I had shown you this slide where I had explained you that there are various capital structure theories are there, but these are some of the important theories that we are going to learn. Net income approach, net operating income approach, traditional approach, and IMAM approach. That is Modigliani and Millar's approach. And first, we have seen certain assumptions related to all these four theories. Last class, we have discussed all these things. Recorded videos are available for those classes. First, we discussed about net income theory. Net income theory is suggesting something that irrespective of leverage, your cost of debt will remain constant. Your cost of equity is also remain constant. That is not going to change because you increase debt in the capital structure. Therefore, you see that irrespective of leverage, that is irrespective of proportion of debt in your capital structure, the cost of debt as well as cost of equity will remain constant. And if that is the scenario, if you try to increase leverage, that means increase the debt in the capital structure, the overall cost of capital, KO, will come down. It will come down because when you introduce debt, you are actually substituting a costlier fund with a cheaper fund. Debt is cheaper. Debt is cheaper to equity. Therefore, this theory says that with leverage, overall cost of capital will go down. Then, friends, we have understood, we had done some problems to test that theory. Some examples we had done in the previous session. Then, friends, we studied one more theory that is called as net operating income theory, where it says that cost of debt will remain constant irrespective of equity, irrespective of proportion of debt and equity. But the cost of equity will increase. Why it will increase? Because when you increase debt in your capital structure, the shareholders will perceive that the firm is risky. Consequently, there will be an implicit cost. There is an implicit cost. That means expectation of shareholders will increase because they're taking more risk. So cost of equity will increase. When cost of equity is increasing and you are introducing more and more debt, the cost of equity will increase in such a way that the overall cost of capital will remain constant. Therefore, this theory says Q will remain constant. That means your capital structure will not affect the overall cost of capital. This is because, okay, you are introducing debt, but cost of equity will go up. That is the theory. And we also did some questions to understand that theory. That this was done in our last session. Today, friends, we are going to learn one more approach, which is called as the traditional approach. Okay, little old approach. This theory says that the optimum debt equity mix means a proportion of debt or certain quantity of debt in the capital structure at which the overall cost of capital will be minimal. KO will be minimal. Friends, we have already understood the meaning of optimal capital structure. Optimal capital structure means we're talking about that capital structure where overall cost of capital is minimal. Okay. And this theory says that debt has an impact on the value of the firm. It says that as the proportion of debt increases in the capital structure because of increased risk perception, not only KE, KD also increase. Both KD and KE increase if you increase the debt in the capital structure. In other words, as the proportion of debt increases in the capital structure, KO falls, reaches a minimum, then it increases. Okay, this can be understood if I will show you this picture. Yeah, this picture says, you see what it says, up to certain point, KD is constant. Up to certain point, KO is also, KE is also constant. But if you increase debt beyond that, then both KE and KD both will increase. When they are constant, the overall cost of capital is falling down. But it increases, overall cost of capital increases. So it fall down and increase. It fall down and increase. Finally, you will see behavior will be like this. That the cost of capital will increase, will remain constant or go down, overall cost of capital. But after a certain time, it will also increase. This is possible. Okay. So this theory suggests that capital structure has got an impact on the value of the firm. It has got an impact on the cost of capital, right? So there are two major assumptions of this theory, that the rate of interest or debt remain constant for certain period, thereafter it increases with leverage. Okay. And the expected rate of return of equity shareholders will also remain constant up to certain time, but increase gradually. As a result of which, the overall cost of capital behaves like this. It goes down, but again it goes up. That is because our assumption is that cost of equity will remain constant up to certain point, then it will increase. Cost of debt will also remain constant up to certain point, then it will increase. So where it is minimum, overall cost of capital we'll find out, and that is my optimal capital structure. I have to understand that is the highlight, that is about the traditional terms. Okay. Now there is one more theory which is called as the middle of the road theory. That means it is, you can say, combination of net income theory and net operating income theory. It says KD changes with leverage. KE also changes with leverage. Both cost of debt and cost of equity changes along with leverage. Okay. So the middle of the road theory says up to a point, either net income theory or net operating theory holds good. Operating income theory holds good. Beyond that point, the other theory, that is NOI theory or NI theory, would hold good. That means what a net income theory says, that overall cost can go down. Net operating income theory says overall cost will not go down, it will constant. So up to a certain point, if you take the middle point, middle path, up to a certain point, overall cost is coming down, then it will remain constant. Or it will remain constant for a certain period, then it will go down. These are the possibilities. And this theory also says the value of the firm is equal to value of the shares plus value of the debt. Okay. To understand this theory, let us solve a question. Here is a question B for you. Just have a look at this. You can read it. Firm is expecting net operating income of 1,50,000 on its total investment of 10 lakh. The equity capitalization rate is 10% if the firm has no debt, but it will increase to 11% when the firm substitutes its equity capital by issuing debentures of 3 lakh. And it will go to 12.5% with debentures of 6 lakh. Okay. That means cost of debt will increase. Assume 3 lakh debentures, rupees 3 lakh debentures can be raised at 6% interest, whereas 6 lakh debentures can be raised at 7% interest. Compute value of the firm, value of the shares, and average cost of capital. Just have a look at this question. We'll be solving it very soon. Let us solve it. So three situations are discussed here. One is no debt situation. Second is debt of 300, that is 3 lakh rupees debenture. Second is debt of 600, that is 6 lakh rupees debenture. EV80 in all the cases is 1 lakh 50, 1 lakh 50, 1 lakh 50. And in first case, when there is no debt, there is no interest. When debt is 300, interest is 80. When debt is 150, interest rate is 42. Why there is difference? If you look at here in the question, it says 3 lakh debentures can be raised at 6% interest, whereas 6 lakh debentures can be raised at 7% interest. So interest rates are different. Consequently, the amount of interest may be 18 or 42. Now, profit after tax comes to first case 150, second case 132, third case 108. It is simply EPIT minus interest. Now, cost of debt, if you calculate here, first case it's not applicable. Second case, it is given in the question 6%, 7%. No need to calculate. Cost of equity, it is given 10%, first case. But when the debt is 300, it will become 11%. When the debt is 600, it will become 12.5%. Now calculate value of the shares is equal to dividend by KE. Value of the share, you can find it out. You will see the share value is going down 1500, 1200, 860. So with the increase in debt, the S value is going down. Value of the debt we know. First case 0, second case 300, third case 600. Overall cost you see. First case it will become 1500. Second case also 1500. Third case it is 146. So overall cost of capital also you can calculate 10%, 10%, 10.25%. So this shows that optimal capital structure is a debt of 300 and a equity of 1200. Because at that value, the overall cost is minimum and the value of the farm is maximum. Right. And also this shows that the trend is like this. Up to 300 debt, the value is not changing. But beyond that, value will be changing. Value will go down. So this is the understanding we have got out of this. At this stage, if you compare all the theories that we have learned, that cost of debt, NI theory says it will remain constant. NOI theory says it will remain constant. Traditional theory says it will increase. Cost of equity, NI theory says it will remain constant. NOI theory says it will increase. Traditional theory says it will remain constant, then it will increase. Net income theory says KO will fall. Net operating income says KO will remain constant. And traditional theory says KO will fall. Value of the farm, different three theories says, first theory says it will increase, second theory says it will remain constant, third theory says it will go up. And equations for value, farm value is calculated. If whether it is relevant, that is capital structure is irrelevant. Answer, net income theory says yes, net operating income says no. Traditional theories or in middle of the farm theories, it is also yes. So this is the summary we have learned so far. Okay. Now, friends, we'll take a break now. Then we'll move to the next theory, which is MM approach or Modigliani and Millar's approach. Thank you.